Welcome everyone to the lecture on market efficiency. I want you to think about market efficiency as a spectrum. Market efficiency is the idea that it's hard to earn abnormal returns. What's an abnormal return, you say? It is a return above what you would expect an investment to earn given its risk. We've covered the basic idea that each investment has a fair return given its risk. One specific model for estimating a fair return is the capital asset pricing model, although you should recall that the capital asset pricing model is biased, imprecise and incomplete. If you can form portfolios that earn higher returns than a normal return on a regular basis, using a framework that you can implement over and over again, the market that you are investing in is inefficient. In contrast, an efficient market is one in which you cannot persistently implement a strategy to generate positive abnormal returns. Every market, whether it is the share market, the property market, the bond market, or some other market, has a degree of inefficiency to it. There is a spectrum of inefficiency. These markets are not completely efficient, and they are not completely inefficient. There is no easy money to be had. There is no easily implementable trading rules which allow you to earn abnormal returns. And we are going to attempt to understand this spectrum of inefficiency. Unfortunately, decades ago, someone came up with the idea that these labels, which are applied to undergraduate courses around the world, are a great idea. The labels of weak form efficiency, semi-strong form efficiency, and strong form efficiency. But I find them terribly confusing. We're going to have to talk about them because everyone else talks about them. But I don't think they're particularly helpful. The labels are weak form efficiency, semi-strong form efficiency, and strong form efficient. If the market is weak form efficient, it means that you cannot earn abnormal returns by analysing historical price and volume information. For example, if the market is weak form efficient, it means that you cannot earn abnormal returns by looking at share price charts. We know this statement is true. You cannot earn abnormal returns by looking at share price charts. The market is at least weak form efficient. Anyone analysing a share price chart, looking at past volumes or doing Fibonacci numbers or putting trend lines on share price charts is just wasting their time. There is demonstrable evidence that you can't beat the market, that is, beat a broad portfolio of all the stocks in the market by analysing past share price movements. The most compelling evidence of this is that you can't identify anyone doing it who actually has any money. They don't seem to exist. I know they don't exist because the evidence is that portfolio managers find it really hard to beat the market. Most portfolio managers, the evidence suggests, cannot do so on a regular basis. Some skilled managers can beat the market, but most managers don't have that ability. But there are courses available that will teach you to analyse past share price movements. The information is basically free, and you can earn massive returns if you are able to do it successfully. If you can find someone who's able to do that, and they are also working a day job, that is the evidence that they are not actually able to generate positive abnormal returns. Consider the following conversation that I actually had with my friend. My friend likes playing blackjack and says, I've got a system for playing blackjack. I say, oh yeah? Tell me more. My friend says, I win all the time. All the time, I say, and I'm staggered. Question is though, why aren't you playing now? Casinos are open 24/7. Friend says, well, the way it works, I can only play for a limited amount of time, and then I have to walk away. What are you talking about, I say? The cards get reshuffled every so many hands. The game begins again. The time that you have been playing can't have any relationship to your payoff strategy. It's a new game. It's a random event every single time the cards are reshuffled. The same conversation could be had regarding analysis of past share price movements. Why aren't you doing that all the time? or getting a computer to do it all the time. You could program the computer to do it if you could actually analyse those charts and make money, but it doesn't work. You don't observe traders analysing screens of, you do observe traders analysing screens of price and volume charts, and presumably the traders are compensated by the employer for generating profits with those trades. But the traders in this situation are operating in an environment in which market information is flowing to them on a consistent basis. They are not generating abnormal returns purely as a result of analysing historical prices and volumes. They are generating abnormal returns because of their continuous exposure to short-term supply and demand for securities, which could be shares, bonds, currencies, for example. A degree of short-term price momentum could signal that a buyer or seller is attempting to fill a large order, broke it up into smaller pieces, and the trader could use some information in conjunction with this short-term price momentum to buy and sell at a profit. We also know that over half the volume on stock exchanges is now the result of high-frequency traders who relied upon a computer algorithm to take advantage of short-term imbalances between supply and demand. But that's different to saying that a market is weak-form inefficient because it can be beaten on the basis of merely observing the trades. Are these traders exploiting inefficiencies who are not working in the market? Sitting at home merely analysing the data to pick the next price movement without relying upon information in addition to price and volume movements? No, they aren't. At the other extreme, we have the idea of strong form efficiency. If the market is strong form efficient, it means that you cannot earn abnormal returns even if you had inside information. We know the market is not strong form efficient because we know that if you do have inside information, you could earn abnormal returns. We know that people with inside information earn abnormal returns, and we can identify those people. Sometimes they get sent to jail, and they do make money, albeit at the cost of freedom. So in short, we can make the definitive statement that the market is at least weak form efficient, but the market is not strong form efficient. Where there is debate amongst researchers and people in practice is the extent of semi-strong form market efficiency. If the market is semi-strong form efficient, you cannot earn abnormal returns by analysing publicly available information. Publicly available information includes annual reports, earnings forecasts, and information from the Wall Street Journal. It is any information which is in the public domain. The job of professional portfolio managers is to analyse publicly available information and convey that to their clients. To convey to their clients that I've got some proprietary way of slicing that information to identify which stocks, bonds, real estate or other assets are going to go up in price. There is a degree of inefficiency in the market which can be exploited using publicly available information. But it's not easy to exploit that information, and not many people successfully do it. But at least we can identify some of those people, versus finding no people who can beat the market with charting. And the debate is the degree to which the market is semi-strong form efficient. Before we get into that debate, let's talk about asset price bubbles. No one can claim that a market is 100% efficient, but that a market also has asset price bubbles, and we do observe the occasional asset price bubble. The most recent bubble you have been exposed to is the property bubble of 2006. Property prices peaked in the United States in 2006. You probably also have some awareness of the technology bubble. The Nasdaq index, which is heavily exposed to technology stocks, peaked on March 24th, 2000. There are three characteristics of an asset price bubble. First, there is a substantial increase in the volume of trade. There is a kind of frenzied trading going on that didn't previously exist. Secondly, investors buying the security have a different composition. Institutional investors start heading for the exits. Retail investors start coming in. And this occurs because retail investors are trend followers. They predominantly invest in whichever asset class earned high returns last year. We know this from analysis of the asset class switches made by retail investors in their retirement accounts. Third, investors buying the security in a bubble do so without any consideration of the fundamentals. Now that is different to investors disagreeing on the value of an investment on the basis of what fundamental information is more important: earnings, dividends, cash flow, risk, competition, and so on. You and I could disagree on what is a fair price for an investment according to differences in what matters for prices and how we can make valuation decisions. For instance, we could have disagreement about when Lyft is going to be profitable and therefore have a debate about what is a fair price to pay for Lyft. But we would all agree that the future profitability over some long horizon matters in some way for our valuation of Lyft. In contrast, in a bubble, we observe investors buy a security on the basis of their faith, as if it's almost a religious belief that a security will go up in price simply because it must. We observe that belief when retail investors bought technology stocks in 2000, when they bought property in 2006, and more recently in their buying of cryptocurrency. I suggest that speculation in cryptocurrencies represents an asset price bubble because the three characteristics of a surge in volume, a retail investor base, and purchases justified without consideration of fundamentals are present. We will know in coming months or years whether my conjecture is correct. What takes the place of fundamentals in the minds of investors purchasing a security undergoing an asset price bubble? Extreme reference bias and extrapolation of past price movements. Reference bias is the belief that a price a purchaser paid for a security has some economic meaning in relation to its future price movements. How many times will you hear, "I'm waiting to sell at the price I paid so I will get my money back"? This is reference bias. Why does that investor believe that the price that particular investor paid will determine a future price, when there could have been thousands of investors buy the securities over the years, and they all paid a different price? They can't all be right in expecting the price to revert to their individual reference price. Extrapolation of past price movements is a belief that the recent price path is indicative of a future price path, which could be a price reversal on the assumption that prices are mean reverting, or the continuation of a trend. Some asset prices are mean reverting. For example, commodities. They are mean reverting because supply and demand respond to price movements. And some asset prices do exhibit trends because supply can't instantaneously respond to demand. But this is not the case with the trading of financial assets like shares. Share prices are not mean reverting and only exhibit the continuation of a trend amongst illiquid stocks, which makes it hard to profit from what appears to be a price trend. If you buy to take advantage of the trend, that trading activity itself pushes the price up faster than you anticipated, taking away the opportunity to buy many shares at the low price. A bubble is caused because, for prices to adjust to a fair level, whether it's technology stocks or property, you need someone selling the security, thereby pushing up the price. But for the price to fall back to a fair level, you need short selling, which means selling something that you don't already own. The problem is that with some securities, like technology stocks or property, short selling is hard to execute. The limited ability to short sell a security means you have an institution sitting on the sideline saying, "This security is expensive. Who would buy it? We should short sell." For securities in which short selling is possible, the investor will sell the security the investor doesn't own on the expectation that the security will fall in price, and this investor can buy it back later at the low price. But if the investor cannot short sell, it means that you have just one side of enthusiasm here. Investors buying the security, pushing the price up, and that's what creates the bubble. Eventually the bubble is pricked and prices revert to normal. This limited ability to short sell is an important contributor to the property bubble. You can be out of the property market because you believe that property is too expensive, but your pessimistic views will not push the price to a fair level. In summary, the existence of bubbles is one piece of evidence that suggests that markets are not completely efficient. Asset price bubbles occur with many asset classes, not just shares. We have inefficiencies in many markets, but most of the discussion below relates to share markets because we have the availability of data which lends itself to a large body of research.